Okay, all right. Class 9, one more to go. Okay, so tonight we're going to talk about quarterly provisions. And so I realized in turning in the final tonight, I would be skeptical of how much reading you guys did for tonight. And after teaching this thing for 8 years, I also know like behavior patterns. But in general, with interim provisions, this is like a paradigm shift to an extent in class, because so far we've learned about doing annual provisions, which is a very balance sheet focused exercise, right? You get the payable right, you get the deferreds right, and then the provision falls into place. So with interim provisions, it's going to be exactly the opposite. We're going to focus really on the P&L, and then we'll worry about the balance sheet as a bit of an afterthought. Okay. So quarterly provisions are very different mechanically than annual provisions, even though we're really just trying to get that annual provision and divide it up into pieces. Okay? So tonight will be hopefully an eye-opener on just the mechanics behind how we do provisions Q1 through 4. Okay, we already talked to Don. Okay. So basic rules. I've left in here the old pre-ASC 740 sites. Again, mostly just like in some of the prior classes, because people, when I talk to Don, for example, we don't talk about ASC 740 sites ever. But if you asked him what APB 28 was or FIN 18, he'll know right away what it means. I mean, we use FIN 18 in our kind of terminology just as if it's kind of second nature. So APB 28 was the original rule that dealt with quarterly accounting, and it basically said that you're really looking at an annual period and trying to look at the quarters as these pieces of that annual period. And the way APB 28 dealt with taxes, APB 28 was broader than taxes, but it basically said that for tax expense, we want you to estimate an annual effective tax rate and then apply that rate to every dollar of income during the year, and from that you'll figure out what your quarterly provision is. Okay? So the key here is you're supposed to come up with an estimated annual effective tax rate for the year, even before the year's over. So if you thought of how we've learned about provisions so far in terms of do the payable, do the deferreds, well, how are you going to do that, right? You don't even know all the facts. So, and if you remember from Don's schedule that I had up on the board, he was solely focused on rate, right? And what he was doing at the top section, which he labeled ops rate, was coming up with what he estimates the annual rate's going to be at the end of the year. And by now you've learned what affects an effective tax rate, right? It's income by jurisdiction, it's perm items, it's credits. He knows what those levers are, and so without going through the mechanics of payable and deferred, he can still come up with his expense by just focusing on those rate items. Okay. Okay. So we're going to go through a handful of steps in terms of how this mechanically works. So step 1, like I said before, you're going to use an annual estimated effective tax rate, and the way you're going to do that is you're going to estimate your annual tax provision and divide it by your estimated annual pre-tax. So the FP&A guys, the finance team is going to give you that denominator. They're going to tell you, well, this is what we're forecasting for the year. And so this number right here, this is coming from finance usually. This is not a tax number. But this number, tax has to calculate. So if finance says, you know what, I think we're going to make $100 million this year, then the tax person has got to take that and say, okay, now I need to estimate what my provision on that 100 million is going to be. So you need to know, well, what jurisdictions is that 100 million in? What permanent items do I expect for the year? What are valuation allowance issues I might have? Or FIN 48 set up a reversal, right? You have to think of all the things that could happen that would impact your tax. And it comes second nature to a guy like Don. He's always thinking, what's my tax rate going to be, right? Even in like mid-November, he's thinking already about year end. And I don't know if you focused on his schedule enough, but it already had a Q4 column. And he's already been sharing that data with people. Like, this is what you should expect, you know, way before anyone's actually thought of doing the provision. Okay, so step one is coming up with an annual estimated tax rate by estimating the provision and dividing that by what you forecast to be your annual income. Okay, step two. So at the end of each quarter, so let's say this is Q1. So you get to March 30th, you make your best estimate of your AETR. So your AETR is your annual estimated effective tax rate. So you come up with your best guess of what your ETR is going to be. Then you apply that AETR to your year-to-date ordinary income. Okay. So let's say you think, oh, you know what, my AETR is going to be 25%. And I'm going to take, so I think I'm going to end the year with a 25% tax rate. So I'm going to take 25% times my quarterly income, and that's going to be my provision. So if I looked at the quarter on a standalone basis, 25% may be completely irrelevant, right? I might have a ton of income in the U.S., let's say, and losses in my, you know, non-resident Irish company like Don was talking about, and that's a terrible set of facts, kind of like Elaine, where the tax rate spikes. And that might happen in Q1, but if you think by year end it's all going to work itself out and you're going to have a low rate because of that income mix between jurisdictions, then you factor that annual forecast in. You don't worry about the quarter by quarter approach. Okay. And what you might notice here is that we're using the term year to date and not just the quarter. Okay, and this is important because in Q1, year-to-date and the quarter are the same. But when you get to Q2, you don't calculate the Q2 provision. In Q2, what you do is you first calculate the year-to-date provision, which is a 6-month provision. And then in order to get the Q2 provision, you take what you did year-to-date and subtract what you already did year-to-date. Meaning you would take meaning this might be 6 months in that example, and this would be what you already did in Q1. So Q2 would be whatever it's got to be mathematically to take Q1 plus some number in Q2 and get the 6-month number you want.
And that's on a weighted average basis, given like the income figures?
Well, you'll see in a second through the example, but the mechanics here, what it's going to do is, if you thought your rate was, say, 30% in Q1, and then you get to Q2 and you're like, you know what, I think my annual rate's going to be like 32%. Well, if you said, well, what's my Q2 rate? It must be 32%. Well, it's definitely not going to be 32% because you need to catch up for the fact that in Q1 your rate was below 32%. Right? So there's a catch-up effect, which is not fun. And if you read Amazon at all, you would have learned about the catch-up effect because their rate was moving all over the place, and as it moved, they had to deal with the fact they booked different rates in the prior quarters. So I think this will come out much more clearly in the example we're about to hit, but just know the mechanics of the guidance is you're not worrying about the quarter, you're worrying about the year-to-date basis, and to get the quarter, you take year-to-date minus what you already did. So the mechanic, the results of that can be somewhat surprising at times.
So in Q1, you're trying to figure out what your whole year's.
Yep. Yep. Okay, so the last step in provisions. Okay, so you forecast for the year, you come up with your AETR, what you think your annual rate's going to be. You apply that annual rate to year-to-date income, and now anything that's weird, all other items, get individually computed, okay, and recognize when they occur. So remember how in Don's schedule he had that whole huge bottom section of well, my statute expired in jurisdiction B, right? So I guess I get to release all my reserves. That's a weird one-time item that doesn't get forecasted. Or if he, one of the line items on his schedule was they had a large restructuring, right? So they had a big layoff. Well, that wasn't something they forecasted. That's weird. That's unusual. So he pulls that out of his annual rate and books that discretely on a one-time basis. Okay? And as you can see from his schedule, he had a lot of those things, right? So there are quite a few things that get booked separate from this conceptual annual rate approach. And we'll talk a little bit later about how you know whether it's in the rate versus not in the rate. Okay. Example 1. Okay, so see if you can follow this, and then if you can, I think this will be a little bit of an aha moment here with the mechanics. Okay. So this is our page of facts. Okay. So at Q1, we thought our annual rate was going to be 40%. Okay. So imagine, you're the provision person, and you're sitting there at the end of March, and you think, gosh, if I look ahead for the year, what do I think my annual rate's going to be? I think it's going to be 40%. Okay? And remember, this is you sitting there at March 30th without the benefit of knowing what it is. You're guessing. Okay? And then when you get to Q2, it's June 30th, you know more about the year, you know what's happening, the forecasts are changing, stuff's happening, countries might have changed their tax rates, right? Things just move. And now, with the benefit of all that extra info, you think, you know what, for the year, my rate's not going to be 40. I think for the year, it's going to be 35. Okay? So this line is you every quarter resetting what your expectation is for the full year. Okay? And then you can see in Q3 and 4 it changes a little bit again. So it goes down, goes up, goes back down. Okay? And for some companies that you'll see, you did the homework where you should have identified certain companies and identified what the fluctuations are. Some company the rate is butter smooth. Other times it's crazy, right? And hopefully from your examples you kind of figured out why. Okay, so the other facts here are what the income is, both on a quarterly basis as well as year to date. Okay. And so we're going to take this table of facts and we're going to calculate the provision every quarter. Okay. So it's a simple example, but it'll prove out or show you some of the mechanics. Okay, so we're in Q1. So I have a slide that looks like this for each quarter. And Q1 is the simplest because we don't have any prior quarters to deal with. So in Q1, we said that we thought the rate was going to be 40% for the year. Right? It's 40% for the year. My year-to-date income is $400. All the stuff in the blue shaded section is just the facts, right? It's just lifting it from the prior slide. So my year-to-date provision would be this number times that number would get me 160. So if my year-to-date provision for Q1 is 160, and I didn't have anything in a prior quarter because there was no prior quarter, then my provision for Q1 is 160, and my effective rate for the quarter, which is going to be A divided by B, this is A, and this is B. My effective rate for the quarter, like when I look at my income statement for the quarter and I see my tax expense for the quarter divided my earnings for the quarter, that's the effective rate that's going to show up on my 10Q. Even though, and in this example it's the same, but even though this could be wildly different from this rate. And we'll see that in a bit, okay? So oftentimes when you're dealing with management types, you're dealing with the CFO. If he says, well, what's my tax rate? You need to say, well, what tax rate are you talking about? Right? Are you talking about my full year AETR? Are you talking about my current quarter rate? Which one are we talking about? And don't assume that you're on the same page, because you're often not. Okay, so that's Q1. That one's straightforward. Okay, so Q2. Hopefully here's where it clicks a bit. So in Q2, remember we changed our assumption. We said that for the year, we thought 40% was too high. We think for the year it's actually 35%. Our year-to-date book income is 500, which is the 400 from Q1 plus 100 for Q2. So if I take this 35 and multiply it against that 500, my year-to-date provision is 175. All right, so now for 6 months, I have a provision which reflects a 35% tax rate, right, on a 6-month basis. But for the quarter, well, if I booked 175 for 6 months, right, this is 6 months here, and I already booked 160 last quarter, that means I only need 15 this quarter. So that's all fine and good, but now if somebody says, well, what's going to be on your 10Q? Well, you'll say, oh, 15%. And somebody will say, 15%, right? So basically you're saying that last quarter, your tax rate that showed up on the 10Q was 40%. Now you're telling me for the year it's going to be 35%, and for the quarter it's going to be 15%. Right? That's wild. And what that is the reason that this is so low and not just simply 35% is we need to catch up for the fact that in Q1 we booked a higher rate on a large amount of income. Is that making sense?
Mm-hmm. Most of the income is in Q1.
You get a loss, too. Crazy adjustment there.
Right, or imagine if the facts were different, and we'll see this here in a second. In fact, why don't we just go on to this slide. So let's go to Q3. Yeah, it doesn't actually show it very well. Let's hop back to Q2. So imagine if the numbers were reversed, and this 40 was your Q2 estimate, and your 35 was your Q1 estimate. Then that would mean in Q2 your rate would spike, right? If you booked a low rate in Q1 and had to catch it up in Q2, your rate would be crazy, right? So that's what's happening with Amazon. And actually, it's funny about the, Grant, you were asking what my role was at Yahoo. One time at Yahoo, that happened to them, that their rate spiked on account of a increasing annual estimated rate. And the rate for the quarter, I want to say, was like 65%. This is a few years ago. And it was just this phenomenon. And Jerry Yang, the then CEO, was like, unacceptable, right? And so they needed somebody to go explain to Jerry Yang why this was the case. And of course, no one wanted to do it. But I raised my hand. I'll do it. And that's my chance to meet Jerry Yang, I guess. So then the VP of Tax, who was no longer with the company at the time, she's like, I can't send an advisor to go explain this to the CEO. That's a bad idea. So she ended up going and sitting in his waiting room or lobby area for like 3 hours, and then he never had time to meet with her, and it never went anywhere. But I remember I had to draft an email basically that she could forward to Jerry that, in as like simple as a way possible, explain these mechanics, which, if you put yourself in his shoes, he does not care, right? He just wants somehow the rate to be more normal. But unfortunately, these mechanics, when Don talked about levers earlier, you can't just turn this stuff off. The rules are very mechanical. So you can tweak your facts and bend here and there a little bit, but these mechanics are what they are. Okay? So in this fact pattern, no one wants their rate to go from 40 to 15 and then presumably back to 35 next quarter. What would you say in your disclosure? Like, my estimates are all over the place and sorry about the volatility, right? That's not good. So, but that's really the story. Okay, so now we go into Q3. And in Q3, we've changed our annual assumption. And now our rate's back up to 37%, but we actually lost money in Q3. Okay? And so our year-to-date income is 300. 300 times 37%, right? This is our same year-to-date rate times year-to-date income, gets me my year-to-date provision. 111, if I want that for 9 months, I know I already booked this for 6 months. So 64 has got to be what I need to get me to 111, right? If I take this plus that, I need to get that. So 64 is a bit of a plug, right? I mean, it's not a plug in that you don't know what it is sort of plug, but it's just the result of a calculation. You didn't calculate the 64%. And that just happens to give you a rate of 32%. And so imagine if you're the tax person and you got to explain this provision to the CFO, right? Because you're saying my rate went from 40 to 15 to 32, and you're telling me my annual rate is 37 now, after you already told me it was 35 and maybe 40, right? So as you can appreciate, there's a lot of frustration between explaining the difference between these two lines, right? And oftentimes people refer to this line as their, this line is sometimes called their Fin 18 rate. Or I often refer to it as that. Or, you know, AETR. But I remember dealing with one CFO who, he was from Montana, chewed dip. And he was just like, what is the rate that is showing up on my 10Q? Right? And we needed to focus on this rate and not worry so much about telling him all the data points, because he's like, just show me the rate that's going to end up on the Q and I have to explain to somebody. Right? And so we would focus just on these numbers. And he didn't really care how we got there, other than obviously he had to explain it to an extent. But to him, he's like, make it real. What do I see? Right? And so you as a tax provision person just need to appreciate that there are the kind of behind the scenes calcs, and then there's the number that actually ends up in the communication. So when you do Q4, you don't really do it in this way, of course, right? We've been learning in this class all along that when you do Q4, you're going to do a balance sheet approach, and you're going to get your payable and deferred right. Out of that, of course, is going to come your year-to-date provision, right? You're going to be able to figure out your 350. And if you compare the 350 that you need for the year versus what you already booked year-to-date, well, then that will give you your Q4 provision. What's interesting about Q4 is Q4 never gets presented alone, at least not usually. So when you look at a company's Q4 financials, you see the years presented. You don't see the quarter presented. And so oftentimes people are less sensitive to what the Q4 rate is, because if you pick up an annual report, a 10K, it will just show 2012, 2011, 2010. It won't show Q4 like a 10Q does. Right? When you look at a Q, it'll show both the quarter and the year-to-date period. Right? So when you look at Yahoo's 10Q for the last quarter, on their income statement, they will have a 9-month section and a 3-month section. But when you look at the Ks, all you see is years. You don't see the quarters.
How much, so we talked about ETR and people wanting to know what that is. What about the accuracy of the AETR? I mean, it seems like that's more the number of people might want to know also about. Where are we going to be at the end of the year? I mean, where are we going to, what's kind of the, when you smooth everything out, what do they really expect?
Well,
Very much focus on that?
Yeah, so Grant's question is, how focused are people on this? And the problem with that number is, in this example so far, we're working with no discrete items. Okay? So when we do the basics of our provision, we do it assuming no weird stuff. Okay? And that's my very kind of casual way of saying, what we can forecast, what's normal, we put into the mechanics of the provision the way we've shown it here. But if there are things that are unusual, non-recurring, or things that are just specifically meant to be recorded discrete, we still haven't even gotten to that yet. And so, unfortunately, if you say, you know what, I think my rate's going to be 40% for the year, but I know there's going to be some significant one-time items like a restructuring or a IRS settlement or something like that, when you tell the CFO what your annual rate's going to be, you better bake those things in, because your CFO is not going to be able to appreciate the difference between one annual rate without discretes that you might use for these mechanics and another annual rate that's all everything in. So it gets very confusing. You have to know your audience in terms of what you're communicating. But this full year ATR, this is your ordinary income. This is kind of the normal stuff. Ordinary income. Okay? And if you have things that are significant and unusual, non-recurring, none of that is baked into this. Right? This is, I'm a company, I make stuff, I sell it, I make money, and then things that happen outside of that, if I cut 10% of my workforce, or my building gets caught on fire, or if I impair my goodwill, or any things that are just weird, that doesn't go into this yet. Okay? Oh, go ahead, Patty. Patty.
Why wouldn't you just go with the statutory 35%?
Well, so like let's say you're Wenju and you eat a lot, right? And you have a lot of meals and entertainment. So I can use that example from the very first class all the way to the end of the semester. So you need to know that, right? Because at the end of the year, your provision is going to reflect a big perm item for meals and entertainment. So you need to forecast that, build that into your rate, and then spread the effect of that throughout the year. That's what these mechanics are doing.
So that's actually, there is a calculation behind that instead of just kind of
Absolutely.
It is, because that's where I was.
Yeah, Don's one piece of paper had this rate, and it looked like it just kind of came out of thin air, but there's a very large workbook that has a ton of jurisdictions all aggregating in terms of what we estimate. There's a lot of work that goes into that number, absolutely. Yeah. Jay.
So would the journal entry just go to a table? That table?
Okay, so that's a good question. And this is one of those things where if I ever tested you guys, I would put that on the exam, like what's the other side of the entry? Right, so if my current quarter expense is 160, what do I book the other side of the entry to?
It's gotta be payable. When you got the provision.
Man, you guys don't learn in the class. What's the right answer? It depends.
Yeah, you have your tax credit payable.
What if you have an NOL? It's not payable so much, huh?
Yeah.
Well, so what do you think the rule is? What did you read in the books? What's the rule? Okay, what's the rule? You can have like an A++ if you know the rule. You guys are like Googling it. It's a trick question. There is no rule. So when you read the guidance for interim provisions, it only addresses the P&L. It doesn't address the balance sheet. So it's nowhere. When I find that with ASC 740, it's a little harder to see. But when you read the old Fin 18, Fin 18 was specifically how to do tax provisions on a quarterly basis. That's all it covered. And all it talked about was the P&L side. It didn't talk at all about the balance sheet. And so the balance sheet is kind of left up for people to kind of figure out on their own. And it varies how people do it, frankly. With Don, we do a pretty complicated calculation of what we think all the moving parts are. And there's a lot of APIC moving, there's payables moving, there's deferreds moving. Plus, you got to remember, it's not one jurisdiction. They probably have 100. So when you ask what's the other side of the balance sheet, you're asking what's the other side of the balance sheet for 100 jurisdictions. So you need to figure out, well, what's a reasonable estimate of what that balance sheet movement is? Because what you want to avoid is you just book payable Q1, payable Q2, payable Q3, and then at Q4 you're like, I don't have any payable, I got an NOL. So then you have this giant reclass, right, to move your payable into your deferreds. And the finance guys are going to look at the flux in the balance sheet between the quarters, and they're going to be like, hey, tax guys, what are you doing here? And that will create problems. So the general answer is on balance sheet, you want to look ahead and see where you think it's headed and come up with a reasonable way of getting from the beginning of the year to end. but it is not prescriptive. I mean, there's not specific rules that you follow there. Okay. Okay, so that's a pretty straightforward example of how to do a provision every quarter, right? Estimate the annual rate, apply it to year-to-date income, and then in a few minutes we're going to add discretes too. Okay, so I guess I should have flipped to the slide as you guys were just asking that question.
Is there a possibility of kind of seeing how good people are? Can someone judge the ability or the accuracy of the guys doing the provision by how much fluctuation there is in there? Or, I mean, if somebody really knew if it was a perfect world, shouldn't they be able to get that right from the get-go and there wouldn't be much going on the bottom?
Without a doubt. I mean, it's incredibly hard to get it right. And it depends which company you're at. You know, if you're at Microsoft and you just print money and every quarter you collect more money and you're able to forecast with a fair amount of certainty, then it's not that hard, right? And of course they have a materiality that is so high that, you know, changes in the noise don't really surface, right? Whereas if you looked at Amazon, they're doing huge things as a company right now in terms of expansion plans, and what that's causing is it's causing some wild fluctuations in certain jurisdictions in terms of how they're doing. And when that mix moves all over the place, the annual rate moves all over the place. And I can tell you, the provision person I talk with up there, I mean, she's helpless at trying to get it right, because they're doing forecasts constantly, and the forecasts all come in different from period to period. And that's just a function of the business, right? The business is changing, things are very dynamic, and the provision person is just trying to keep up. Yeah. Okay, so this was your question: to what balance sheet account is the provision recorded? The answer is there's no guidance. The preference is to figure out a way to split it, and boy, it's all over the map. I mean, I feel like I've seen a lot of variations on this. What most people do, and I think it's a wise thing, is they try to limit in the conversations with their auditors what the variables are, meaning that they'll say, look, maybe we'll look at, you know, our top 2 or 3 temp items, but other than that, we're not going to study them every period because it's just too much work. It's just things I'm going to get wrong. So maybe like my FAS 123R, my stock comp deferreds, I'll analyze every quarter, or my intangible amortization I'll look at every quarter because those are big. But otherwise, I'm not even going to touch bad debt reserve, or I'm not going to touch depreciation or something like that. It's too much noise. But every company's different. Okay? And so when you look at how they do quarterly provisions, you should always ask, well, how do you do the balance sheet? But you should ask in the spirit of, I want to understand it, not that I bet you did it wrong, because it's kind of hard to do it wrong as long as you have some rational way of applying the rules. Okay, so let's do in-class exercise 1. There's a handful of exercises tonight, but these are not that hard compared to some of the problems you've been doing. So we can kind of take our break at the same time we do exercise 1, and we'll restart again in, I don't know, 10 or 15 minutes. Okay? Okay, so up on the screen, actually I haven't plugged it in yet. You know, it's just slightly too big. You guys see that? Okay, so up on the screen, I have the solution. And let me see if I can tweak this. Okay, so what we're trying to figure out, for starters, is our annual effective tax rate, right? And the key to that is to know what our ordinary income is. So in our simple example here so far, we're just assuming we're in one jurisdiction. So we want to know, well, what's our income going to be? We know what the tax rate is, and we've said no perm differences to make it easier. But we do have a credit, right? Like let's say it's an R&D credit. So when we get to Q1 and we're trying to forecast, well, what's our annual provision going to be? Remember, our AETR is going to be our forecasted provision divided by our forecasted PBT. Okay? So if you took $100,000 of forecasted provision times 40%, that would be your forecasted tax before credits. It would be 35 after credits. So my AETR for the year would be that $35,000 of forecasted tax expense divided by my $100,000 of income. And if I take that 35 times my Q1 income, which I said over here is 25,000, if I take 35% times 25,000, that will give me 8750. Okay? And at Q2, remember the first thing I'm going to do is I'm going to come reset my AETR. And I'm going to say, well, gosh, based on 80,000 of income, my numerator in my AETR calculation is now going to be 32. 40% of 80,000. And after my credits, it's going to be 27. And 27 divided by my 80 is 33.75. So this rate is lower than Q1, mostly because my credits are just a bigger percentage of income now. Right? The credits didn't change, but as on a relative basis, they became more significant. Right? That's all that happened. It's just math. And so sometimes people refer to that as the denominator effect, right? So now that my annual effective tax rate I'm estimating to be 33 3/4, if I apply that to my year-to-date income of 30,000, that's where I get my 10,125, which should be my 6-month provision, right? Because I took my annual rate times 6-month income should give me a 6-month provision. And if I've calculated my 6-month provision and I already know what I did in Q1, this just has to be my Q2 provision. Okay? And that 27.5, that's what goes on the 10Q. Even though that's pretty different from what you expect for the year. Right? And that's that catch-up effect again. We following that? Okay. So then you go to Q3, and for the year, okay, again, I'm going to start by updating my AETR. My income is the same, but now my credits got bigger. So, of course, my rate's going to go down, right? So now my rate's 27.5 for the year. And you would have guessed, well, gosh, if it's 27.5 for the year, I booked 27.5 last quarter. I'm good, right? Well, the problem is that 27.5 was catching up for the high rate in Q1. So really what you have to do in Q3 is you have to catch up for the fact that on a year-to-date basis, as of Q2, you were using this rate. So you have a long way to go to get from 33 down to 27. And so mechanically, you're going to take your new AETR of 27, multiply it by the 55,000 of 9-month income, and that will give you a 9-month provision. And that 9-month 15 minus the 10 that you already booked through Q2, that will get you what you need for Q3. And that's a low number from an effective rate perspective, because again, you're just catching up for the fact that your annual estimate keeps going lower, and you need to catch up for prior quarters. Okay? When you think about the whole idea of the provision being that you're spreading the annual effect throughout the year, well, as you change that estimated annual effect, you got to spread it all throughout the year, which means you have to catch up for what you've already done. Okay? Okay, so that's the solutions to exercise 1. Okay, any questions on that? Okay, can't show that clock on the screen, it'll drive you guys crazy, huh? Okay, so what we just learned was the mechanics of quarterly provisions before considering items that are separately recorded. Okay, and as we talked about a minute ago, Don had lots of those. And so we're going to learn about what those are and how you deal with them. So this slide basically says that certain items get excluded from the AETR. And for those items that are excluded, the effects are recognized discretely. Okay? So the biggest thing that Don had in his schedule was he said, well, gosh, as of Q3, I had this gigantic gain, like this $5 billion gain from selling shares in that Chinese joint venture. And that's pretty unusual stuff, right? You're not doing that every day. So he pulled that out of his AETR, and we'll explain why in a minute. And so what he did was, instead of spreading the effect of that throughout the year, he booked that effect discretely. So he said, I know incrementally what that's going to cost me in tax. I'm going to calculate it, and I'm going to book it all in Q3, because this one-time event is very much one time. Okay? And when you pull that out, for purposes of doing your AETR, right, you take that tax effect out of the numerator, meaning you don't forecast the tax expense related to that item, right? And you also exclude that income from the denominator. So when you're doing your AETR, because you still need to do that, just like in the last problem we went through, you do that whole exercise, basically excluding the effects of that event. Right? And so if you thought of the AETR calculation as being the annual estimated provision over the annual estimated PBT, for something like that China equity sale, you pull that out of this part of the equation and out of here. It's as if you don't have that. Right? And then you'll see in a second that if you exclude that China transaction from both numerator and denominator, you will come up with an AETR on your, quote, ordinary income. And what you will do is you will apply that AETR to your year-to-date ordinary income. Not all your income, just the ordinary income that doesn't meet this one-time or kind of unusual description. Okay? So what Tom would have done is Don would have done, sorry, Freudian slip there. What Don would have done is he would have said, look, I'm going to calculate my AETR as if that China transaction doesn't exist. I'm going to calculate my rate, I'm going to apply that rate, and I'm going to apply it to year-to-date income, excluding the effects of that China transaction. Okay? So the key is, on this slide, if something is called out as separate because it's not ordinary, it gets fully pulled out, okay? Pulled out of the numerator and denominator of your AETR calc. So this slide talks about items that are excluded. The most common one is this one right here, significant, unusual, or infrequently occurring items. Okay? And so this could be a you know, a divestiture. It could be restructuring. And some companies treat restructuring as ordinary because it happens so often. Other companies don't. This could be a goodwill impairment. Which one of the companies you've had a guest speaker on, they will have that next quarter. So if you want to just keep taking the class, in like 2 months we can talk about that 10K. That's probably what you want to do, right, Caitlin? Just want to keep on going. So, you know, this language right here, the significant, unusual, and frequently occurring, right, that's pretty conceptual language. That doesn't tell you what fits in or not. So this is where judgment's required, and a company kind of creates its own path on how they do things. The other thing in here that Tom's busy. The other thing in here is when you can't sufficiently estimate something, you don't estimate it, right? You just book it as it comes. In some companies, you'll see this from time to time. In fact, EA does this. They've been doing it for quite a while, and it's publicly disclosed. When they have a hard time forecasting their annual effective tax rate because of just the volatility of the business, they'll just say, you know what, we're not going to estimate anything. We're just going to book our provision every quarter as it comes, which is pretty rare, right? Because most public companies pride themselves in being able to forecast and being somewhat stable and that sort of thing. So it defies logic a little bit to say that you can't forecast. But if you can't, the rules basically say, fine, don't. But most companies struggle with saying that because it just doesn't run consistent with what they're trying to do. So this section right here really deals with items that are in the financial statements that you might consider as not ordinary income, right? But in addition to that, and this was probably hard to pick out on Don's schedule, sometimes there's items that affect your provision that don't really have a corresponding book income item, right? So things like changes in laws or tax rates, or changes in a valuation allowance. There's nothing in PBT for these things, right? But they also fall out of the description of things that are ordinary and kind of normal, and I'm using language really loosely right now, but these things seem like kind of one-time events, right? Or at least non-recurring events. And so those types of items also get excluded from the AETR. Okay? And the way I would describe this is, if something affects current year PBT, or is impacted by current year PBT, then you put it in the AETR. If not, then book it discrete. I mean, that's kind of a good general rule. So things like, you know, a change in tax laws, right? If you have an NOL of $100, let's say, and the tax rate's 35%, then you have a DTA of 35. If the rates change and the tax rate goes to 25, your DTA now is no longer 35, it's 25, right? That NOL is worth less to you because it's going to save you less tax. That change, that has nothing to do with current year PBT, right? Nothing about how you're making money this year affected that law change and how it remeasured your DTA balance. So as a result, something like that, you would book that discretely. Okay? If, you know, you weren't filing in California and you were like daring Amanda to catch you and she never caught you and the statute lapsed, then that has nothing to do with current year income, right? So you book that discretely. Okay? So that general guideline will work for you most of the time. Okay? Gosh, you guys do seem cold. Like the two of you in the back row, man. You guys are like bundling. Okay, we get that. We get kind of what's excluded versus what's included generally. This is like a gosh, like an infinite, dog chasing the tail exercise in terms of defining what is and what isn't ordinary income. And so know that the boundaries become gray at some point. In fact, one of the slides that we talked about on the panel today is we had this slide that basically had a spectrum of things that were definitely in the rate as normal ongoing items, and then we had a section that was like definitely not in the rate, and then we had a whole gray box in the middle, and we said, boy, sometimes people put these in their rate, sometimes they don't. And Rusty and I put that slide together for another group, and we just replicated it today. But we thought of like 8 or 10 items that we put in that middle section that you might go to 2 companies, and one would put it in the rate, and another would book it discreetly. So just know there's a lot of gray area. Okay. Okay, so a lot of this is just replicating some of the stuff we've already talked about, but I want you to focus on this language of unusual or frequently occurring. That's definitely the buzzword. And again, those get excluded from the AETR, and instead you book them discreetly. Okay, and hopefully this will get fleshed out to an example that we cover in a bit. Out of period, I'm not going to cover. Exercise 2. Okay, so for exercise 2, let's just look at that one together a little bit. Okay, so what you can see for exercise 2, so this exercise, I'm going to pause the video in a few minutes and you can work on it. The key with exercise 2 is in Q2, we have something that we call an unusual one-time expense. Okay? And I need to shrink it down just a little bit. Okay, and we say that that expense is non-deductible for tax purposes. Okay? So, like, let's say that, I know one time when we were using companies as examples in class, one of them was Intel. Intel paid a huge fine for violating antitrust laws, or at least settling that they wanted to stop talking about it. And so they paid a really large fine. Assume it's something like that on a infrequent basis, a company is incurring this expense. It's a non-deductible expense, and but it's not something that we think belongs in the annual rate because of its just unusual nature. Okay? So what I want you to focus on is, if you're the CFO and you want to know what's the tax rate that hits my 10Q for Q1, 2, and 3, come up with that answer. Okay? What rate hits the 10Q for Q1, 2, and 3? Okay? And you'll notice we made the facts pretty darn simple at the top here. That, we don't have a lot of moving pieces in terms of what the annual effective rate is. Okay, so take a few minutes and come up with what is the rate that's going to show up on my Q1, 2, and 3 10Qs.